Hello, my name is Lisa Mahoney, and I am an accredited financial counselor. My goal is to educate, empower, and encourage you to make better and informed financial choices. We're going to discuss uncertainty, the emotions around it, and how to effectively deal with it financially. Uncertainty can mean a lot of things. Uncertain means not able to be relied on or not known or definite. It can also mean not completely confident or sure of something. Anything can happen. There can be a loss of income, a sudden large expense from an illness, or a government shutdown if you're a federal employee. I define financial uncertainty as an event that causes a significant change in income or expenses. This presentation is for educational purposes only and does not constitute financial, legal, or tax advice. The concepts and strategies shared are intended to inform and empower, but may not be suitable for your specific circumstances. Consult with a team of qualified financial professionals, including but not limited to registered investment advisors, accredited financial counselors, tax professionals, and attorneys, who can provide personalized advice tailored to your unique needs. Any references to specific companies, products, or services are for illustrative purposes only and do not constitute endorsements. By participating in or viewing this content, you agree to assume full responsibility for your financial decisions and outcomes based on the information provided. We're going to cover four main areas that include acknowledging the emotions that you may feel, how to assess and address the situation, how to adapt your finances, the actions you can take, and some resources that can help. We've all experienced times of uncertainty, and you can pause, pivot, and proceed to adapt to your financial situation. Personal finance is about emotion, behavior, and math. Any situation can cause feelings of uncertainty and anxiety. And there are several emotions you may feel. It can impact relationships with friends and family members too. Your emotions drive your behavior with your finances, and you can adapt your finances to any situation. Adapting finances works if you are single, married, divorced, widowed, a parent or not, and if you make a little or a lot of money. If you are single, find a trusted accountability partner, someone who loves you enough to be honest with you. Anyone married or in a close partnership has built-in accountability. To adapt your finances, assess where you are currently. The four areas of information you will need to collect are what I call SIDE. That is savings, income, debt, and expenses. To adapt finances, make a plan. It's important to have one so that you know what to do when something happens. The best kind of plan is a cash flow plan to map where your money goes. Mapping information means you need to get organized. Be patient with yourself, the process, and your progress. This is not a one and done approach either because every day, week, and month are different. Be persistent with the changes you make. Be realistic and honest with yourself about where you are now financially and where you want to be. Get organized and collect statements for your savings, income, debt, and expenses. For savings, you want to have anything that's immediately accessible, such as your savings account, CDs, bonds, high yield savings account, money market account, and investments that are not in retirement. Income may include pensions, VA disability, dividends, alimony, child support, and refunds. For debt, you want to collect your most recent statements for your mortgage, credit cards, vehicle payments, student loans, and medical bills, and anything else that you might be making payments on. regardless of the interest. For expenses, you want to review your most recent 3 months of bank statements to see where your money went. You'll be able to catch any quarterly bills as well. In order to take control of our finances, we have to feed our emotions by building a plan and using tools and data to make informed decisions. We fight fear with facts and anxiety with empowering actions. To sort through your information, prioritize basic needs to live, work, and stay healthy. This includes groceries, housing, transportation, and health. Focus on those areas first. You can map cash flow to see what you have and what you spend. You can use a variety of options to map cash flow. It can be as simple as a pencil and paper, an app or online tool, or an Excel spreadsheet. There are many options available, and the best tool is the one that you use. It will take some time to get organized, and it shouldn't take all day. Eventually, it will take about 15 minutes or less to map every paycheck or month. It will not be perfect ever because life is not perfect. It usually takes about 90 days to feel comfortable and anticipate expenses. When you focus and prioritize, it becomes more clear what you need to live, work, and stay healthy. With all of this information, you can see where your money is going and pivot your finances until the uncertainty passes. Whenever there is uncertainty, go on the defensive to survive. This is sometimes referred to as storm mode. Save up as much as you can from all income sources. If necessary, you can either reduce or pause contributions to college and retirement savings. Communicate with your household and make a plan. Call creditors, lenders, and service providers regarding any extensions or skipped payments. Usually only car and credit card payments are offered skips. If you are making extra payments to pay down debt, stop doing that for now. Make minimum payments on everything and save the extra cash. And delay big expenses such as remodeling, vacations, and other large purchases. And know yourself. Acknowledge any fear or uncertainty that you may have. If you normally spend to reduce anxiety, take a moment to pause, take a breath, and ask yourself, will buying or spending on this item help or hurt my financial situation? You can also adjust your spending by trimming normal expenses that you have for now. Instead of eating out, hitting the drive-thru, or ordering takeout, meal plan and cook at home. Review all of your subscriptions to see what you can suspend or cancel, and make sure that you are choosing between wants and needs. There are additional ways to adapt and use what you have. We save for 3 reasons, and one of them is for emergencies. Use any savings not in retirement to carry you through any periods of uncertainty. That's any savings not in retirement. So you can liquidate or empty your money market accounts, high yield savings accounts, CDs, savings bonds, and investments that are not in retirement so you can survive. Try using cash instead of cards for purchases so that you will spend less. Sell stuff and turn your clutter into cash to support your family's well-being. Items can be replaced. Create income. What talents or expertise can you use to bring in more money? Is there a part-time job you can get? Get help. If this is a new experience for you, ask for help and assistance. Consider what will harm your financial situation and possibly make things worse, because there will be some things that you need to avoid as you weather this situation. Taking on more debt will actually hurt your finances and create more payments and higher amounts of debt. Avoid retirement loans. I'll show you on the next slide how it can impact your future, and I'll also offer some alternatives. Remember wants versus needs. Is it a need? Is this expense going to help or harm the situation? As I mentioned before, we should avoid taking on debt during periods of uncertainty. And many of us look to our retirement balances as an emergency fund. You have diligently spent years or even decades contributing and investing your funds to prepare your future self. Let's take a look at this chart by J.P. Morgan Asset Management. This is their annual guide to retirement, and they illustrate the toxic effects of retirement loans and withdrawals. In the top half, what we see is a 25-year-old earning $30,000 a year that increases by 2.5% each year. They are invested in 60% stocks and 40% bonds. Assuming that they take no withdrawals or loans, this individual at the age of 65 with 40 years of investing will have $1.3 million. Now, what we see at the bottom half of this chart is that this person took out a loan in his 30s, his or her 30s, and then there was a repayment period. And then there was another loan around the age of 50, along with another repayment period, and then a withdrawal in their 60s. Now, what we see based on these two loans and withdrawal, even though there were repayment periods, is that at the top of the chart, we see that the bottom line is about 30% less than had this individual not dipped into their retirement savings. So something you should be aware of. There is an option to take a hardship withdrawal when you are not yet at the age of 59 and a half. But when you do that, you are incurring a 10% penalty because you are not 59 and a half or older. Now, in addition to that, for that hardship withdrawal, there is a mandatory 20% that is withheld for federal taxes. And depending on where you live, you may need to pay state taxes as well. So if you are withdrawing $10,000 and there is that 10% penalty, which is $1,000, plus the 20% federal taxes, that's another $2,000. That $10,000 that you probably need is being reduced to at least $7,000, if not more. And so the other option that you could take is do a retirement loan, and then you don't have to worry about the 10% penalty. But when you do that, you will permanently reduce your investments, and your income will be reduced for a repayment period. So depending on the employer and depending on your pay cycle, if your employer offers a 5-year repayment period and you get paid biweekly, that means there will be 130 paychecks of reduced income. And I don't want that for you. So how about instead we bring more money into your paycheck and we're still taking advantage of where that money would have gone, such as to your retirement contributions. So here are the items that I am proposing that you consider instead. So I would ask you to consider temporarily lowering or pausing your retirement contributions. And I know how important it is for you to continue to invest so that it grows over time. I can understand that completely. But remember, this is for a season, okay? And the other item that I would suggest is that you consider adjusting your withholding if you get large tax refunds. Finally, the third option, and this really depends on whether or not you have a high deductible health plan with a health savings account. If you do, it's a regular account that you're putting money into, possibly. And if you are, you can decrease or pause those HSA contributions. Now, when you make these changes to payroll, there will be some tax consequences. So you may want to consult with a tax professional if you're considering these options. You can also consider avoiding making emotional investment decisions, okay? So be sure to consult with your registered investment advisor or perhaps a certified financial planner or other licensed or credentialed investment professional. Here are some resources to get you started. During times of uncertainty, there is a big increase in identity theft and fraud. Go to annualcreditreport.com to check all 3 credit reports from Equifax, Experian, and TransUnion. This is the only place where you can review and dispute items on your credit reports. If you discover credit cards or loans that have been taken out in your name that you did not authorize, file a police report and then go to IdentityTheft.gov. You will get a customized action plan and checklist that you can use in order to address any identity theft issues. If, as you are reviewing your cash flow plan and your expenses, and you discover that making debt payments is interfering with your ability to pay for your basic needs, I recommend you contact Money Management International. They will work with your creditors and lenders to lower your payments and interest rates on your behalf. Money Management International is a nonprofit credit counseling organization that can help. They will work with you to list all of the items that they can negotiate on your behalf. They will charge a nominal initiation fee and nominal monthly fee in order for you to be a part of a debt management plan that will help you to pay off your debt within 3 to 5 years. Finally, you may be interested in some free calculator tools and resources that I have provided. So you can find those by going to the tiny URL link that you see, and that will take you to a Google Drive where I have some items stored. Dealing with uncertainty and the financial unknown can be scary. Take some steps to get organized, review your expenses, and make some changes. If you found this presentation helpful, please share it with others who might benefit. Together, we can empower more people to take control of their finances. Thank you.